Good evening, and thank you for joining in today. Thank you for taking the time to join us. I know markets have been giving all of us plenty to think about lately. One day, the discussion is about AI changing entire industries. The next day, it's geopolitical tensions. And somewhere in between, clients are asking, Sir, market kyun gir raha hai? So today's session is really about making sense of all this noise. We'll briefly look at how AI impact sectors like IT, what recent geopolitical developments mean for the Indian market, and most importantly, what the medium-term outlook for India looks like. Because while headlines keep changing every week, the real question for investors is what actually matters in the long run. And to help us break this down, we have someone who understands the market and mutual fund industry extremely well, Mr. Sunil Subramaniam. With his deep experience and practical insights, we are very fortunate to have him as the strategic advisor for MFD Growth and Asset Plus Academy. Thank you everyone for joining in once again. Mr. Sunil, thank you so much. Thank you for joining us today. Over to you. Without further delays, we'll start.
Thanks, Kanya, and good evening, everybody. And my sincere apologies to the technology issues that we faced. But without wasting much time, as you can see from the screen, I'm going to cover two topics today: the impact of AI on the IT sector specifically, and what the current geopolitical scenario impact on the Indian markets. Right. So let me start off. So first of all, what is the reason we are doing this? Because in February, Nifty IT experienced its steepest monthly decline in 17 years. And in the month of March, there was some bit of easing because of the fact that the geopolitics took over and IT seemed to be literally safer. But it's still on a 1 month return basis, still down 15%. So, and year to date, it's still down 20%, right? Understanding this is basically that what is the most recent event? Now, Indian IT has been affected by the AI premise for quite a long time, right? Even before this, it was suffering. But this anthropic shock which happened, by now, I think you've got enough information on all of this, how the AI agent Claude from Anthropic is able to take complex, heavily intensive data documents in the legal field, sales fields, analytical fields, and crunch it and do it in a fraction of the time that a human labor needs. So basically, as you know, the fundamental model of Indian IT companies has been about software as a service, right? So SaaS. So this, because it's going to be something which is directly hitting a lot of the employee intensive work, which is needed to go through hours of documents, is being called a SaaS apocalypse, means apocalypse plus SaaS, right? And hence, this is the bread and butter of Indian IT firms, and potentially there's a threat of 30 to 40% revenue, that is top line sales deflation. On top of this came another AI tool called the Palantir, and the Palantir which claimed on a different aspect, which is the SAP migration. For many of you who don't know, SAP is one of the largest firms in this field who have got a software which takes end-to-end process management of any company in whichever field, right? Right from purchases through the manufacturing process to sales and marketing, right? There are hundreds of companies which run purely on the SAP. There are a few competitors to SAP, but SAP has a 80% market share in the world. Now, as the companies change, as the environment changes, this original SAP installation needs to keep on getting modified to fit to the changing dynamics of the market. So IT companies are the ones who step in, and they have dedicated SAP engineers who have trained themselves in the SAP process and go and help the companies to do the change and migration to keep SAP up to date. Now, SaaS as a manufacturer doesn't offer that later support, and the entire IT industry gets into this thing and has been again another bread and butter. And especially these projects are important because the change is constant and continuous, and it's a multi-year project for each IT company with a client, right? And that's where Palantir claims that this multi-year transformation, we can make it happen in weeks, right? So two clear threads, and the value of Palantir, I don't know whether today you read the news, right? America has been using the Palantir in their war against Iran to choose the sites to hit and attack. In over 1,000 locations, it has helped. So the power of AI is really being felt now in multiple industries. And for IT, because it's a source of revenue, is where the biggest hit is, right? So as a result of this threat suddenly popping up, what happened was IFI started simultaneously withdrawing from everywhere from IT. And mind you, this time it's not just India, right? So far, prior to this apocalypse moment, Indian IT was particularly seen as very old, not willing to change with the time, no AI related strategy. They are like sitting on cash, not doing anything. They're declaring bonus issues to give the cash back to their customers. So there was a negative, I think, that you're not prepared for AI. But this one now is an actual, direct, clear and present danger. So all IT companies all over the world, which the foreign IT companies were assumed earlier that they would somehow manage it and do it. But this came to the realization that no. So there was an IT sell-off worldwide. And that IT sell-off, right, again played its hand in India. So we got a second time hammered for the same crime, which is our non-AI readiness as a country and as a software industry. And normally this is very clear from the fact that when this selling happened, it was talking by huge volumes. So that's what is called as a strong hand selling or a heavy hand selling, right? Now, what does this mean for India, right? In India specific, what is happening? It's very, very clear now that AI can replace multiple people at work. Hence, a customer would not be now willing to pay on a project for saying, oh, I'm going to employ 35 people. Each person costs so much per hour, his billing is so much. So that's how I build the project. That is going to become history, if not already becoming. A lot of customers have already started asking. So what they want is, tell me what it will cost to do this project. You employ 10 people, 100 people, use AI and employ one person. That's fine. But I want the end result delivered. That's it. So the billing cycle, the way it's being built, it's a business model change and survival. Not every company is expected to adapt to this so fast because the legacy business is there. So to that extent, right, the market is now seeing which firms move towards outcome-based pricing faster to offset the account of headcount-based billing. The third aspect here is that clearly existing employees are a threat. There's no doubt. You remember TCS quite some time back laid off 12,000 people. Well, that's just the tip of the iceberg. Because if this business model is going to change, you don't need that many people at all. But yes, you will need AI friendly people. You need people to take that AI on multiple places. I'll just come to where the AI can be used. But the new AI person is going to be much more costlier than the existing low-end coder developer, so the cost, the margins will get squeezed because of a higher labor cost, though you might actually go and reduce your labor by attrition and laying off people, right? So the point is that you're going to lose the old revenue stream sometime in the future. It's all a gradual process, but the market as usual is discounting the entire future to today. And so most analysts are expecting that there'll be a 12 to 18 month plateau as the two marry off. There are old projects already signed, which will give a revenue stream, but the new ones which come in will come in at a lesser profit margin and they'll do much more business. So there will be a trade-off and there'll be a 12 to 18 month fairly earnings plateau for IT companies is the market's expectation, right? And then the fact of the matter is that the entry-level coding, which is the bread and butter of the inferiority, is being automated by large language models, large learning models, right? So it's just shrinking the market for services. Because when customers themselves adopt some of these AI agents, they won't need IT companies so much. So that's the replacement of the IT company. One is to say, I will take your work, but bill it to me differently, which is a business model change. Second is to say, I'll try and do this because especially in Anthropic, what Claude does is to set it up on your own computer, that software. So which means the company itself with adequate AI people being hired, the end client of the IT company can do that work. Okay. And then the pricing, right? So when you come to this pricing, because they had a SAP project for multiple years, an IT company could give guidance to the market saying, I expect this kind of revenue, because for even next year, they could give a guidance. But now if you're doing per project, how far can you successfully give guidance for the future? Who knows at what price? So that safety element that a company's earnings, there is a predictability, which was a big factor for IT companies, is also under threat, right? So finally, if you look at the AI, one of the things that IT companies will do, and which is a positive here, is that they can use the AI to internally reduce their own cost. That's operating leverage, right? So their own How do they, for example, use AI to write code for a fixed price project? The profit per employee could actually increase if the revenue stays flat. The revised business model. Because if you use it internally to price these projects, to do a lot of the backend which was going into how to bid for a project, do all of that can be done by AI. IT companies could actually benefit from their margins from AI, right? Right. So this is the hidden upside that's probably in this whole negative news, not yet reflected in the current PE compression that IT sector is facing, right? So analyzing the impact now, the first thing, of course, is the valuation reality check. There's a structural re-rating going underway. And as the table on the right shows you, today the trailing PE of the Nifty IT is down to 21 and a half. It might be a little bit lower up because this is end of February month that I took it, whereas the 10-year average is 23.8. So clearly it's already at a discount to its 10-year average. And in fact, certain companies like TCS and Infosys are at a much heavier discount to that 10-year average. So clearly from a valuation, what has happened, the market has historically paid a premium for the predictability of IT earnings. We just discussed that. That has been shattered by AI. Right. So to that extent, and mind you, this correction of such a steep level has happened in both mid cap and large cap. But mid cap was so highly valued that even after the correction, it's still trading at 30 to 40x. Right. So clearly there's a valuation reality check now where you have to look at each company and see whether the valuation is justified. That's number one. Number two, right? The unit economics of labor, right? So what happens?
Sunil,
Yeah.
Yeah, sorry for interrupting. Can you just like close this all tools section? Like click on the cross over there, so it will be wider. Like the
All
all
tools.
tools. Yeah,
Yeah.
beside that there's a just close that.
Done?
Yes.
Okay.
Yeah. Thank you.
Thanks for that. Okay. Right. So there are three aspects to this threat to the future earnings growth. We did discuss it, but I'll just repeat it back again. There's a collapse of the billable hours model, right? If a AI tool reduces 100-hour task to 10 hours, the company still charges revenue drops by 90%. That's number one. Second is the efficiency give back. In the recent contract renewals, apparently global clients are demanding AI productivity discount from the IT company of 15 to 20%. Because what are they saying? There is AI now. You can use that instead of a person. So give me a discount. And IT companies are forced to do that. Of course, they will use AI, but what happens is that their top line goes down because of that, and naturally the bottom line. Thing is the international insight. Like I said, what Claude was doing was to set it up on their system. But what the big companies are doing, Fortune 500 companies, they're internally building AI centers of excellence. They no longer need 5,000 developers from Bangalore company to come and maintain their legacy code because they can have an in-house team doing it. So the competition comes from three parts: collapse of the business model, the efficiency give back that customers are demanding, and the internalization by the customer of the AI handled tool, which are all of which are a threat to the IT services business. So I've given all the bad news. Is there any good news in this? Well, the good news is that the typical market valuation is called the discounted cash flow technique, right? Now, what happens there is that you take the projection of the earnings and use the equity market's discount rate, right? The earnings will grow every year. You discount it all to today, right? Now, for the next 1 year, 2 year, 3 year, 4 year, there is some visibility. You can do that. But what all these valuation models do is that after 5 years, they take a permanent, it's called that terminal value calculation. They assume that at a certain level, the earnings will grow forever and take that and discount it. And that's how you get at the book value, right? The price versus value, the value they arrive, then they see the price is more or less than that projected, whatever you call net present value of the future earnings, right? Now, the issue is that what is happening because of AI, this model is taking that terminal value almost close to zero. So that means they're discounting it for extinction. Now, that's not going to happen. These IT companies will manage, brand, and survive, albeit it's a lower profitability, right? So there's some amount of replaced value there, which is not being currently viewed by the market, right? So, and why we are feeling this, I mean, I've also, JP Morgan and HSBC have also come out with this. What is that? It's called the magic box. There's no magic box which a customer of IT company can simply take and plug and play and do. AI requires complex data plumbing, security protocols, integration with their work. That still requires the domain expertise of IT firms. So different revenues or streams will also open up even if a company chooses to internalize the AI to some extent. Second is that some of the CEOs are arguing that AI makes something they're saying impossible economically viable. What is that? There's a new, there is so far, they've got ignoring AI, right? Now, when AI comes in, there's a 300 billion services opportunity in areas like AI trust, sovereign AI. So AI itself will create a no. And the parallel I can think of here is in terms of computerization of banks. If you remember a couple of decades ago, when computerization first came to banks, those unions were objecting hugely, saying so many jobs you lay off because of a computer and all of that. Then the unions got their pound of flesh by getting a higher increments and thing. All the Bengal employees got it, and then they agreed to computerize it. Today, we are a fully computerized banking industry, but has the number of employees come down? No. It's just that new areas of employment has opened up within the banking industry. So ultimately, Indian people will get jobs, but in a completely different from the simple coding level jobs that are there today. So that's the transition. So those new opportunities, right? It's not just for the IT companies, but for the budding employees from the engineering colleges who are trying to go. The solution lies in different set of skill set, AI related, which they need to develop. So the counter narrative to some extent is overdone the fear. Next, the bullish pivot. What is that? Moving beyond the threat, right? Now, when they actually charge now for, let's say, outcome-based pricing, what we will do is they can start proactively bidding and build it in a way that they still have a residual profit. Obviously, they will need to build the extra cost of an AI comfort employee into that calculation. But what happens is that if they do that and at the back end and go and say, okay, you want, I'll not use billable hours, I'll code for the project. But the extent to which they can use AI to reduce the number of employees needed to support the project, that is internally, they can, if they can keep the entire profit to themselves. So that's a big way the smarter IT companies could be able to, if they move quickly to this transition and do it, right? Second is that there's a massive backlog of data debt in global corporations, right? So before any user company can use AI, it needs to clean and organize its data. And that is currently fueling already a multi-billion-dollar data engineering boom for Indian IT firms. A new line of business is open. And what's driving this boom is the fact that India's data cost is among the lowest in the world. It's only 16 cents per hour, whereas in the US it's $6 per hour, right? You can see this chart. So what I want to say is that from an IT perspective, there are multiple new opportunities which will come up for these IT firms. Not every IT firm will be smart enough to grab it. There'll be a winner takes all there. Some will definitely be losers, but it's not like there's a doom to extinction for the Indian IT companies, right? So then from an investment perspective, how do you look at it? So first is that now IT has moved from a growth zone to a value zone. When was it in value zone last? Pre-COVID. After COVID, this whole Internet of Things and all of those things came in, and IT became a growth story over the last 3 to 4 years, right? But now it's come back to a value because of the steep correction and the uncertainty about the future. So where does this value come from? The dividend yield. The IT companies today, on the right-hand side, I've given a sample there, are still giving a healthy 3.5 to 4% dividend yield. Why this is important? Because there are investors, right? This is not the normal retail investors and all that. There are long-term pension funds, gratuity funds, right? For whom income is important. So they prefer to put their money into these kind of stocks where there's a good dividend yield. And internationally, dividend yield is a huge asset class. In India, because we are a growth-oriented country, there are dividend yield funds, but they're not true in terms of the dividend yield. They're more a value. There's another name for value is a dividend yield fund, we all know. So this dividend yield investors from abroad, for example, would now look at IT very, very clearly because they have the ability, at least over the next 2 years, definitely to deliver this kind of a dividend yield. So there's a yield support floor, which is a favorable thing. The second is that all of these companies have cash reserves. So their cash flow remains robust. So what is it they're doing with the cash? Because they have the cash, they are actually paying you to wait while they navigate the transition to the AI first service model. So in the process of the business model, for them, one of the biggest protections is that they're sitting on huge reserves of cash, right? So that's one way to look at the IT balance sheet, right? So what then from an investment outlook from a medium term, right? What is the bear case and what's the bull case? The bear case is if the AI agents become good enough for autonomous maintenance, earnings could stagnate or decline for several years as the tech industry transition away from it. Right? So if these agents at the user companies can become good enough, don't know, but that's the worst case. What is the bull case? The current crash provides a rare entry point into high quality companies at crisis level valuations. Now, if they are successfully able to pivot to this outcome based pricing, that is charging for the solution and not for the hours, their margins could actually expand. Right? So these are the two extremes from an investment outlook. So as an investor, what should you do? Right? So for the large caps, the AI threat has caused a price correction, but the earnings correction is still unfolding, which means that what are we saying? So you look at it, look at TCS and Infosys. They're trading at a 25% discount to their 10-year average PE. Right? That's a huge discount. So what happens is that, like I mentioned, this growth versus value, IT has now become value. So to that extent, this is a generational, once in a lifetime entry point for these solid companies, because the massive scale, deep clients act as a big protection. If they come with a new solution, the companies will give them right of reverse refusal to their customers. Right? So for example, because they're trading, there is as a value investor, there is today you're getting these shares cheap. Okay, but it should come from the value component of your portfolio and not, as it was the case post-COVID, from the growth part of your portfolio. So every person has a mix of growth and value in their portfolio. This now shifts into that, and as a value play now, it's probably never going to get this kind of a price. I mean, there can be a little more correction, but still from a generational entry point. But if you're a growth investor, then the risk is remains high. So until these companies can prove they can grow earnings without growing the headcount, the stocks may remain dead money for 12 to 18 months. As a value investor, you can accept that there's dividend flow coming back to you, there's a protection on the downside and all of that. But if you're a growth investor, then you could be disappointed. So this is the story as far as large caps are concerned. As far as mid caps are concerned, they are still trading at high multiples, as I said. So they will all move faster than the large cap into the AI offering space, undoubtedly. But if that doesn't translate into immediate revenue, then their valuations could collapse. So which means that you can't buy them as a pack. You have to track individual companies, see which is winning the AI battle, the transition, and maybe pick that. But to buy the mid-cap stocks as a pack at the high valuations, because IT sector itself is no longer a clear-cut growth story. There's a value play in it. I would say mid-caps are probably in a kind of high risk status within the IT space, right? And finally, in terms of taking IT exposure, two things to bear in mind. What is that? That is, yes, you have either you can buy IT stocks or you can buy technology sector mutual funds. But please bear in mind that all diversified mutual funds in India already hold significant proportion of IT stocks in their portfolio. So if you are an investor in flexi-cap or multi-cap or those kind of funds, bear in mind that you are already exposed to the IT sector. So when you are now layering on top with your technology fund on top, because you're a value investor, you feel I can add to it. Or if you are an individual stock investor and you say I want to add large cap to it, bear in mind that in your portfolio already have a X level of exposure. Take that into account before you go and take this as a investment opportunity from a value perspective in the IT system, right? So that's my summary on the AI space. We'll take question and answers after I complete the entire thing at the end of it. But current geopolitical scenario, my second half of today's talk. So before I step into it, I want to tell you one thing, that India, prior to this war starting, already was facing a geopolitical scenario. What is that? That was the AI impact. The reason I say that is, like I told you earlier, Indian IT companies were already suffering the fact that they were not perceived to be AI ready. And from a geopolitical perspective, right, because of that, and one of the reasons that FIs have been pulling out money from India is not just that India's valuations are too high, or suddenly we had a GDP growth drop, or tariffs came and hurt our future prospects because America as a market was shut down. All that was there. But more importantly, as an investor in India, you know, right, you choose the best opportunity for returns, right? If you feel small caps will do well, you put in small caps. If you feel gold will do well, you put in gold, right? Every investor has an opportunity set of investments. And for them, because India as a country was not perceived to be AI ready, they chose to put the money into AI ready countries, Korea, Taiwan, China, and the US. So, since we are not AI ready as a country, already one geopolitical impact is there already hitting our markets and valuations, because there's pullout from money from India and putting that money into Taiwan itself is a geopolitical event, right? So that's, remember that. Then we'll come now to the current geopolitical scenario. But in terms of this, I want to start off by saying that look at the way past geopolitics has affected the stock markets. So when the conflicts are given, the conflicts, the time frame, and after the conflict, obviously there was a correction in every conflict, right? Look at the 1 year returns, the 3 year returns, and the 5 year returns of past conflicts. You can see that in most cases in a 3 year, it's been a double digit bounce back. In 1 year, some case after 1 year also, it's still been negative, like the 9/11 attack on the US, and everything was very, very bad. But by 3 years, generally the markets have come back to double digit returns. The one exception was the Kargil war for India. Of course, this particular conflict, we don't know how it will go. But I want to just reassure you that first, that no geopolitical blocking. In fact, in the second last one, which is the Russia-Ukraine war, 2022, that 1 year itself, the return was 7.5 after the conflict, and was 12% in 3 years. So, to that extent, remember that all geopolitics is a sharp, short panic attack, and over a period of time, market settles itself. So, broad message. Now, let's look at some of these individually. So, Russia-Ukraine war. What actually happened? Sensex crashed 2,700 points on that day. And in the first 20 days of the war, 4,000 points. But within a period of 10 trading days, the volatility was there. The market didn't kept losing more. It stabilized at the lower level. That's one. Next, Hamas attack. Market reaction, immediate impact was very less. Because why? Because the feeling was that this will be a short war and it will quickly get over. That was the thought process, right? So within 2 to 3 days, the market stabilized. And by December, from a perspective of that year, Sensex was already hitting new highs. The next is the Iran attacking Israel, and Israel responding to the limited strike. What happened again? Sensex fell from 75 to 72, 3.5% down. But despite that multi-day slide, once the market realized that both sides were seeking to de-escalate the situation, market recovered. So that's what about the June? Israel launched surprise attacks on 100 targets, trying to get rid of their nuclear facilities, right? This was a big event because it was an unexpected sudden attack. Census crashed by 1,300 points, but recovery was surprisingly fast. Within June, it had already bounced back to 82,000. Why? Because again, it was a quick go in there, attack, come back. Iran didn't retaliate in a big way. Then you had our Operation Sindoor. Forget about days. Within hours, the market recovered immediately. One reason I'm pointing out this kind of a thing to tell you is that when you then summarize, Indian stock markets are particularly sensitive to one thing in terms of the geopolitics, which is the oil factor, right? Because India imports 85% of its oil. The Russia-Ukraine crisis lasted for a long time in terms of correction because Russia was a major exporter of oil in the world. India used to buy a lot from Russia before the crisis also. So how was that going to play out? Second aspect in these corrections is that panic is always front-loaded. It's like, shoot first and ask questions like that. The market, let's say, market participants say, I'll sell today. We'll worry about buying back later. So that panic is front-loaded. So the first 24 to 72 hours, most of the correction tends to happen. And there's a 3-month rule. Historically, Nifty has returned 3 to 6 months after the shock and given between 7 to 19% return after. So this is an overall summary of a geopolitical issue. Now let's come to this particular issue. Why is the market correction sharp? Panic. And what's happening is because of the oil factor. Where is the oil coming in? Because of the Hormuz Strait factor. It's 21 miles wide, the Hormuz Strait. As you can see from the map, one side is Iran, another side is the UAE and Oman. So Iran controls the strait. 20% of global oil goes through. So because of this shutdown, oil prices spike. India specific, double of this, 40 to 45%. India one time it was as high as 65% before, comes with this Hormuz trade. So clearly, one, impact on oil prices itself. Second, the impact for India, because if you have to get the same oil through another route, the transportation costs are going to come on top of the oil price. So clearly, this one goes directly as a big threat to India, and that's one of the reasons the market correction, right? And if you look at the sectoral implications, first of all, is that fiscally the government will have a challenge on its hands. Do you cut the excise duty to protect the customers? Then what happens to this year's fiscal deficit? Or do you allow it to pass through to the customers? And what happens to inflation? Right? So government has a choice between fiscal health or risking growth, because inflation can hurt growth. So that's one, a sustained level of increase in the oil prices will lead to hard decisions the government need to take. Can't sit here today and say, no, government will tilt this way. There are a couple of big elections coming up. So government may not take the option B, but then you have to manage the fiscal. So that's the first thing. From an FI perspective, on investing in India, this has taken India's risk one notch higher as an emerging country. Second aspect is, of course, the airline industry is one of the biggest getting impacted, because not only 40% of the operating expenses of an airline are from the fuel. So the cost increase is going to directly translate to a hit on their bottom line. On top of it, they're seeing loss of business because the airports got closed. And it's not just the travel to the Gulf. Travel to entire Europe goes through the Gulf. So to that extent, now the airline industry is naturally facing a challenge. So that's there in the mind of FIIs. What about the oil marketing companies, the IOCs and the BPCLs and the HPCLs? Every $1 billion rise in crude means a half a liter decline in their gross market margin. So naturally, and on top of it, if the government asks them to absorb it, that's the situation, right? Unless the government absorb it by excess duty cut at their end or passes it on. So there are three choices the government: either put the problem as presented on this slide to the OMCs. So that's a big threat to their revenue stream. Yes, technically the ONGCs in all India, because oil prices rise, will benefit from a super profitability. So yes, for every $1 increase in the dollar price, EPS rises 1.5%, 2%. So potentially you can look at and say that if the oil price sustains for a long time, then you can look at that these sectors will get positively benefited, right? But now what I want to point out is that the whole market has been corrected. Now this data is a few days old when I did the provision. Subsequently, the market has corrected even more, right? But if you look at this whole slide, what I want to point out is that the sell-off is widely across Nifty 50, Nifty Bank, Nifty Mid Cap, Nifty Small Cap, Nifty Micro Cap. Maybe 1 or 2% is quite different, but everything is selling off. Why? That's because when FIIs sell, right? If you look at it then from a sectoral analysis perspective, clearly the sectors which face the hit are the crude importing sectors like paint, tires, aviation. So that accounts for the fact that some of these stocks are in the mid cap and the small cap. And there's obviously some amount of counter because defense and IT. Where does IT come in, defense come in? Because when there's geopolitical war threat, they feel that there will be some demand, some Indian exports for defense to somebody will go up because of that. So this is a sentimental rise in defense. Then IT is seeing that because of another reason. One, the oil price rise leads to currency depreciation. You've already seen, right? Rupee is well past 92, 92 and a half now. Who knows next week where it's headed, because direct impact of oil price will be there. The second is there is a flow of smart money into the dollar now as a safe horizon. So when the dollar strengthens, the rupee weakens. So that rupee weakening story is probably being played in the IT space. So some amount of defensive nature of IT is coming to play in this geopolitical scenario, right? So why I'm saying this, when you now look at it from a returns from a YTD perspective, right, and look at it, the point I want to make is despite all of these corrections on a 3-year basis, the markets are still reasonably up by the 39% absolute return, which is about 11% compounded average. On a 5-year basis, it's still 62% absolute, which is about 10.5. So the market is still given a double-digit growth despite the recent correction. So first thing is that this correction is an immediate impact correction, In fact, 1 year returns, it shows 10.86. Today, that's why it's about 8.8. Right? So where I'm coming from is there's a lot of cushion in the Nifty to have absorbed this. So the longer term investors will not feel the heat. Yes, I know. Over the last 18 months, people have not made any returns, and that's beginning to worry them. That's very true. Right? So I want to now look at this and say that we know that the war is not perennial. It may get worse before it gets better. But one way to look at it is to say, after the war and the dust around the war settles, what is the way forward for India? Because other than the impact of oil, yes, oil may impact our GDP also to some extent. Oil may impact the margins of companies, but it's all till the war comes to an end. We cannot predict the war coming to an end, right? Because tomorrow Iran suddenly says, okay, already there are some soft noises coming from Iran in some form to the other Gulf countries apologizing to them. And America, I think there are some rumors that doing a heavy bombing tonight, destroy what is left of the Iranian arsenal. So for all you know, this war could suddenly come to an end. At that time, all of these corrections that's been happening over the last week, 10 days, would be the best buying opportunity for you. But that's only if there's no permanent damage to India's future because of this. So I want to take a look at, say, leave this crisis aside. How is India? When we come back to the reality check of what is India, once the dust is settled, you will then realize that you got a golden opportunity to buy, right? Because this correction was not a severe correction of India's growth story. That much you have to understand, right? So then when you look at it, look at the Nifty 50s just over the so many years. In the middle, you've seen Kargil War, 9/11 Indian Parliament attack, Iraq War, 26/11 attack, Palama attack, then the Russia conflict. Can you see the graph of Nifty? There are corrections there, but ultimately it's ending up higher. So at any of these crises if we had invested, the level that the Nifty has reached means that it does not matter that way. So if you had actually bought in the corrections, your returns would have been much more better than just the CAGR of return point to point, right? So just in one snap graph, I want to show you that the longer run, none of these conflicts has prevented the Nifty's long-term growth as an index, right? Second, we're just coming off a back with a fairly decent earnings season. So if you take the AMFI classification of large cap, mid cap, not to the index here, and look at the column number 4, right? Sorry, 1, 2, 3, 4, 5, 6. You can see that the profit growth of large cap was 7.2%, right? Profit growth of mid cap was 16%, double of that. Profit growth of small cap was 31%, and micro cap was 38%, and total market is 12.4%. So one of the things I want to tell you is that this 7.2% also was because the labor code hit. If you take away the labor code, the Nifty itself goes up to double-digit 11%. Right? So it's a one-time effect of the labor code provisions. So the earnings season was fairly good, strong double-digit earnings. Right? The next one is that the sector-wise earnings. There are sectors which have grown very strongly. Profit growth of PSU banks was 24%. Profit growth of private sector banks is 14%. Capital goods sector 35%. Auto 31%. The share prices have also risen, but it's on the back of these strong results. So there are wide swaths of the economy, right? Between capital goods and banking, you can say that it covers more than half the economy. It's been growing well. So India's growth story was recovering in terms of the actual earnings growth, right? And if you now look at for the future, for the next year, so the market buys into the future, right? I've taken the consensus estimates. What is indicating? It's showing a U-shaped recovery in India. For next year, 26-27, large cap index is expected to grow 14% earnings growth. Mid cap index 20%, small cap 28%. Bear in mind, yes, the valuations of PE ratios of 20 and 28 and 30 are showing that it's not still a cheap market. But I'm just saying it's a U-shaped story. It's an improving story in front of you. And within sectors, again, the consensus estimate for banking is about 16%. The IT services is itself over 11%, right? Despite all this AI and everything, for next year, it's not going to hurt their earnings growth. And for manufacturing, 24%. So overall on the earnings, we are on a recovering mode from the slowdown that we saw last year, right? And then when you look at it, right, because of this geopolitical whatever corrections, right? And this is, like I said, was as of a date. Since then, market has corrected even more. So if you now look at it, right, Nifty levels and the P ratio of the Nifty, and then you normalize it for the labor code, And then you take the 1 year forward, you're seeing now that the Nifty is at a 24,800 level, is at a 19.23 PE 1 year forward. And if the Nifty, God forbid, comes down to 23,500, we're 1 year forward at 18. So we are getting quickly into a relative value zone, which could again trigger an inflow of FIIs into our market, right? And if you take what is the trailing 12-month EPS and the EPS adjusted for labor code, and then 1 year, we are expecting that from 1142, which is the current quarters, it should go up to 1289 earnings for next year. So why I'm saying this, all this correction is also making us much more reasonably valued. It will take some time to get into true value zone. Okay, by the way. Second aspect, yes, we've been hurt by the valuation story, people taking out money. We've been hurt by our non-AI readiness being punished. So as a result, what's happened is India's premium to the emerging market, we are still at a premium, has come down. So in the left graph, you can see that the current PE premium is now 58, whereas the long-term average is 68. So we are now trading at a 10% discount to our own premium. We are not at a discount to emerging market. Okay, bear in mind. But so I'm saying that getting into that reasonable valuation territory where historically whatever premium we have enjoyed, we are now trading cheaper than that. And now if you look at it, this correction is not hurt only us. Look at the markets. There's the Nikkei, the Straits Times, the Hang Seng, the Taiwan. Everything is also deeply corrected. So why I'm saying this, in this correction, the panic correction, because they all went up more, they're also suffering more. So the correction is not related to India alone. This was a risk of correction that has happened. Now, where are we now? Because of this correction, the market had to get revalued. So MSCI Emerging Market Index, which all the passive funds rely on, our share has dropped. So the right-hand graph I draw your attention to, right? Yellow is China, which went up and is slowly coming down, the weight in the index. The green happens to be India, and Taiwan, sorry, green happens to be Taiwan, which has steadily been going up, and the blue happens to be India, which is steadily coming down. So why I'm saying one of the reasons we have faced FII outflows is because passive funds have to mimic the index, the passive MSCI Emerging Market Index. So because our share of the index as calculated by the index provider has been coming down, automatically people have to book profits and take it out. So now we have reached a level of 13.34%, which, as I said, is quite low. We were at 16, 17%. So what I'm saying is that this has already come down sharply. So from now on, with the AI thing being reset in the other countries, over the next few months and a year, you will see this 13% probably head back towards 15, which should automatically attract more FII flows into the country, right? And then nothing in that growth story has got affected. If you look at India's contribution to world GDP growth, China is contributing 26% by absolute value of the world GDP growth. India's second at 17%, more than the US. US is just at 10%. So we are not only the fastest growing country, we are the second largest contributor to the world's absolute GDP growth. So we are a very important country for the world's growth. Remember that, right? And you had all sorts of good news which has been wiped away by this geopolitics and to some extent that AI. What is happening? See, capex. After last year's stabilization of the capex, we have again taken capex up in this budget. So spreading that capex across the whole lot of sectors. So the government capex is going to be a multiplier effect on the economy, and the government expenditure will spread on a lot of new areas to support the India's growth, right? So there is a good budget. Then we have the Indo-EU deal, the mother of all deals, right? Because it caters to 25% of global GDP, the entire EU as a space. And for us, it's an export engine of $75 billion, right? And almost 9,425 tariff lines have been crushed. 99% of Indian export now enter the EU duty-free. The benefits of this will flow in over time, right? So it's a positive future growth story happening just from the EU deal, right? And if you then compare with the US deal, right, this will be a medium-term deal. It will take a bit of time to come through, but it's definitely going to provide India a medium-term growth story. And what about the US deal? Yes, we know we ourselves have called a halt. Why? We had signed a deal at 18%. But court had asked Trump, and Trump switched to a 150-day 15% tariff. So we'll be foolish enough to go and sign an 18% deal when you are getting 15%, right? So naturally, we have called a hold to it. But Mr. Trump himself has basically said that the deal is on track. Obviously, the terms will be renegotiated. So what I'm trying to say, the deal hasn't gone away. Obviously, the Trump is now busy also with the war. So once all this dust settles, doing a deal with India, and you're seeing that so many positive news, right? They are going to allow India to buy Russian oil again, right? So from that point of view, the whole reset in terms of Indo-US relationship, you have to bear in mind, means that this deal will ultimately come back on track, will be signed, and for the medium-term growth of India, it's a solid story, right? And private capex, right, has started now catching up with government capex, as the two lines show you here, right? So the red line is the center's capex, which has been right. The private capex, which from 2010 had a lead, now the private capex is starting to pick up and move. So when that comes in, that's a further boost to our GDP growth efforts. And on the digital front, right, we are already in the leader. Our UPS has been recognized as the world's largest payment system. Our data costs were very low, right? And our young youth of our age, the low dependency ratio, the demographic dividend will come through. One of the reasons that in AI we were on the back foot was because we need to provide jobs to so many people. So us being at the forefront of the AI revolution would have been a political suicide. But we have to use, adapt, and then our people have to become the AI consultant engineers for the rest of the world. That's where this whole digital cost being low, us getting this UPI and everything being there will help us. But this is ultimately going to be the pressure force driving Indian GDP growth, right? And if you see, the government recently came with the revised GDP numbers. Yes, the nominal GDP of the country, absolute level has come down because of the recalculation, but India is now growing faster to at 7.6%. At this growth rate, India will easily reach 10 trillion by 2036, right? By which time China would have overtaken the US. And we are poised to increase our contribution to world GDP growth to 20% almost for many decades to come. From our current, you saw the earlier growth about 17%. So we are going to be one of the biggest contributors to world growth over a long period of time. And our per capita GDP, even if you assume a conservative 8% GDP growth, will hit the 10,000 number by round about the time we think Viksit Bharat will happen, 2043 onwards, right? So based on this projection, by the Viksit Bharat period, we should be a 20 trillion economy, and dreams come true. 2075, we should be a 50 trillion economy, overtaking the US. So all I'm trying to put this is, when you look at it in the context of India's story there, all these short-term corrections, I would say, are something that actually represent a buying opportunity for buying into India's future. The journey will be rough, the volatility will be high, but if you stay the course through discipline, right, long term, as I showed about the Nifty chart, which is growing despite all this geopolitics, your future in an India is absolutely secure from a wealth creation perspective, right? So the nominal GDP of the country is expected to go 10 times from FY25 levels, right, to FY45 levels. And you know that in the long run, during the course, the journey is up and down. Nominal GDP is relatively flat. In any country you take, I've taken Korea, China, and India here. Over the long term, the growth of the stock market beats the growth of the nominal GDP of the country. So if, as I said before, we expect nominal GDP multiplied 10x, you can say that the stock market is definitely going to multiply your wealth 12x or 13x or 15x, right? Thank you very, very much for listening to this presentation. And Sugnia, maybe if you have time, we can open the floor for questions.
Yes, Sunil. So I don't see many questions today as such.
Okay.
If in case anyone has any questions, please feel free to drop in the questions. We'll just wait for 2 minutes. If in case anyone's dropping in any questions, we'll take them up, else we'll end it here.
Yeah, sure.
You can stop sharing. So,
I have done that.
no, you have not. You can stop sharing the screen.
Okay.
Yes, perfect.
Good. So that's okay. So there are no questions. People are always can reach out to.
There is just one question. So Mr. Prabhakaran is asking, what is the right time to enter the market? I guess.
So I guess it depends on your time frame in mind. So if you have a time frame over the next 3 months, then I wouldn't say that it's the right time to enter the market, because every day news about the war keeps changing, what's happening. So I would not recommend it for a shorter time. If you're a longer term person, the time frame actually doesn't matter. So my suggestion to you is, before the war started, you had a certain portfolio allocation, whatever form it is, based on your risk appetite, your long-term goals. You had a certain allocation. I'm saying don't use this opportunity to change it. First, don't change that. Second, use this opportunity to buy your portfolio in small bits in the same proportion right through the war. So that is assuming you have some surplus cash on the side which you have not invested. This is not the time to book profits in a sector and put it in another sector. No. If you do have spare cash, I would say replicate your portfolio in microcosmic amounts every day through this crisis period. That's the best. So there's no right time or long time here.
We have another question from Mr. Mahendra. So he's asking, can we go deposit or invest for 3 months target?
No, but 3 months target, clearly a deposit is far secure. I have no doubt about that. See, the problem is that I tell you this today, and tomorrow Iran surrenders and the war ends. The market will shoot up. Then you say, sir, what, you told me to put my money in 3 months deposits. So I cannot predict the uncertainty in the short. So when I say put it in a deposit, it means that I'm protecting you from the volatility. There's a price to pay for the volatility. What is the price? The price is that if the volatility ends, you've missed the market gain. So it's still a call for you to take based on that.
Right, we'll take one last question. So this person is asking, mutual fund is better or buy stocks directly?
So I would say mutual fund is better, because I'm asking you to put very small amounts of money every day. So with a very small amount of money, how many stocks can you spread it over? Because I don't want you to be choosing stocks at this point in time. For example, oil-related stocks are correcting far more, but the bounce back will also be far more, because the threat of oil goes away, it will go. So to that extent, I would say that mutual funds are still a much better bet, because over a space of your entire portfolio, you would be definitely having, if you have large cap, mid cap, small cap, and a set of other funds in your portfolio, you must be exposed to at least 200 stocks in the market. So I think that's the best way, that you put a small amount of money, you still get exposure to 200 stocks. Whereas for you to go and buy those 200 stocks today is not going to be a small amount of money.
All right. Thank you, Sunil, for answering all the questions. Just addressing Mr. Prabhakaran's message, we have received your number. We'll be reaching out to you and addressing all your queries. Thank you, Mr. Prabhakaran.
Sure.
All right. With that, I think we can end today's webinar. Thank you. Thank you, Mr. Sunil, for sharing those
Thank
valuable
you.
insights.
All the very
Always
best.
a pleasure to learn from you. I think one clear takeaway from this session is that while markets may react to news and events in the short term, what truly matters is understanding the bigger picture and staying focused on the long term direction. And yeah, so thank you, everyone. To everyone who has joined us today, thank you for taking the time to be a part of this session. With that, we'll conclude today's webinar. Thank you once again, Sunil sir. Thank you so much. And thank you, everyone, for being with us. We'll be back with our next one. Have a happy weekend.